Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jimmy Lee, CEO of Wealth Consulting Group, to discuss why the risk of recession has been pushed to later in 2024. Jimmy, it's great to have you with us. Welcome to Trade Talks.
Good to see you, Jill. Thanks for having me on.
You got it. And let's talk about where we are right now. It really feels like we are in a season of certainty to round out the end of 2023.
We really are. I think investors are really looking for some catalysts to point us in one direction or another. But I think there's enough people that believe we're going to have a potential fourth quarter rally to get some buying on the dips, as we're seeing, last week and today. The market being as strong as it is, I think with the geopolitical risks that we're seeing overseas right now, shows some sign for money wanting to go to work.
Well, I mean, the base case for you all year has been the strength of the consumer. They would be the ones to stave off this recession. But going into the latter half of 2024, you see that, the risk of recession is higher there, which, makes sense. Debt levels are as high as they ever have been and savings are dwindling down. So what's your thesis on the consumer, and why do you think the second half of 2024 is when we could see that recession?
Well, I actually don't think we're going to get into a recession. I've been bullish all year long on the consumer. Thinking that the consumer was going to stay strong, and primarily because the U.S. economy is still producing jobs, and people are earning maybe not as much money to keep up with inflation as they need to, but more than they were before pre-pandemic. And so the labor market being strong is one of the reasons why I thought that we would avoid a recession this year, which is what we've seen so far. And I thought in being invested in risk assets such as equities would be a good place to be, which I think so far it still has. And I do believe we will have a potential for a fourth quarter rally, really depending on what the Fed decides to do in November and beyond. But with that being said, yes, the risk of recession is higher in 2024, but I still think we're gonna not get there. But if the Fed continues to raise rates, they could tip us over, and they could tip the consumer over. And we're starting to see the weaker part of the consumer, debt levels rising, interest payments being more delayed and late and things like that. And so a lot of it has to do with the Fed, but I think the Fed's also going to be a little bit more cautious than what's going on with Israel and Hamas and all that.
So with this backdrop, how are you allocated?
So we think investors should stick to quality across the board, both equity and fixed income. But to give you an idea of a little bit of the positioning, we've actually leaned into duration on our fixed income part of our portfolio. We think that in the short run, rates could be volatile, but if you're looking for kind of a longer term trade, 2 to 3 years out, we think rates are going to go lower. And when they go lower, investors will be able to pick back up some of the losses on the principal on their bond allocations in their portfolio, which in 2022, it wasn't because equity markets went down so much, was such a bad year for investors. It was that bonds were down a lot at the same time.
So should we get the best case scenario, right, where it turns out your thesis is correct and we get that strong Q4 rally, do you think there's any risk for a correction as investors start to think about taking profits?
I do. And to finish that last section on the equity side, we think that cyclical sectors, including industrials and even tech, we think that tech, good quality tech, is a good place to be. And even public real estate, we think is discounted, even though there's a lot of potential risk for equity investors in real estate and the private side in the next 12 months or so, as interest rates have really caused a lot of developers to slow down their projects, and there's just not as much deal activity going on. And we think a lot of equity investors might walk away from some of the equity that they invested previously in some of the real estate. But on the public markets, we think that that the public side is discounted probably about 15 to 20% off of where the private side is. So I think that's those two areas of the both private and public side are going to meet a little bit, but the opportunity is there for the public side of real estate. So we like cyclical sectors. Again, our base case is that we avoid a recession even in going into next year, and that the consumer is going to stay healthy as long as the Fed doesn't continue to raise. And if they do one more, I think we'll be really teetering on whether or not we do end up getting that recession. But if they don't, I think we could see a market rally. And in sectors that are, affected by rates, interest sensitive, and like technology for valuations and real estate, I think can pop.
All right. Appreciate the insight, Jimmy. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great to see you. Thank you.